Where do you invest your money in 2025? We have seen a tremendous amount of unpredictability going on with what the Trump administration is trying to do as they shift this economy from a globalized economy into a more centralized economy. America only is the way I see it versus America first. So, where do you invest your money in 2025 given this? We are systematically being removed from globalization, and we're doing so, or being done so, ripping a band-aid off. The tariffs are punitive. Now I have a breakdown here. I want to show you from an economic perspective how these moves are going to affect the economy and therefore the stock market. So how do you invest in 2025 given these parameters? The one thing you want to look for is growth. And where are they going to grow relative to the United States? Faster would be Germany and the EU. Now, I have a whole breakdown. I'm going to show you how Brexit being removed from the EU affected the economy in Great Britain and their sort of lack of growth from there. Given that, the United States could be looked at as the next step for a removal from a globalized sort of environment, economic environment. But what happened with the United Kingdom and Brexit was far less harsh as to what the punitive moves are going to happen here in the United States. Given that with the tariffs at 25%, see, the United Kingdom didn't do that. They just removed themselves from free trade. The United States is punitively being forced to not participate in free trade and globalization. Whether or not this is a good policy or not, okay. Another thing I think we're going to see, two things I think we're going to see is the United States gets removed from NATO. Now, I'm a veteran. I was stationed in Mildenhall, England for nearly 4 years. And I can tell you, NATO's a relic. I actually see this as something where, there's a lot of benefits to that. Why are we footing that bill anymore? If you want our troops there, feel free to pay for it. It's kind of my take on this, regardless. If we do remove ourselves from NATO and Europe, removing our troops from there, this could have benefits in the sense that we could reduce our budget expenditures here in the United States, given what's going on over there. In the meantime, Germany, the European Union are expanding and rearming, and that is growth versus what the United States is doing, contracting. You want to chase growth if you want to grow your investments. So when I break down how to invest in 2025 based on this aspect, we're comparing on a relative basis the EU versus the United States. Now I've put out a few little sort of feelers on this. I'm looking at FEZ ETF as the mechanism to invest in Europe. It's sort of the S&P 500 or the Dow Jones 30. It's the SOX 50 for the EU. They will outpace growth in Europe versus, on a relative basis, the United States. Now, I'm all for expanding my portfolio, and I have some sort of very savvy trades for those of you who are slightly more sophisticated than others, going short the S&P 500 versus buying the SOX 50 FEZ ETF, and by doing so, should both move up or both move down, you would still profit from that. What we're looking for in that particular trade would be a narrowing of the differential in the growth rate. Nonetheless, let's break down everything that I'm looking at and why I believe if you want to invest for growth, you want to start taking a look at the European Union. Let's jump in. Just shifting through as I'm looking, stock market was down sharply today, rallied back higher, positive. Now it's back down, looking like it wants to go back up. It's this instability that I'm really kind of breaking down. One thing you want to do, make certain to follow along. I am pushing towards more Substack versus the other platforms that I'm looking at. I have a LinkedIn page that I'm repurposing my videos onto there. You'll want to move over to my Substack to get my email newsletter. Also simultaneously, YouTube, again, thank you for all of those who have been jumping over and grabbing my newsletter. The newsletter looks a lot like this. It will have a video on there. This particular snapshot does. I took that video portion out just to give you an idea as to what these emails look like. You can subscribe and get the email, or subscribe and only get on the app. It's a great way to communicate. Another thing, I started my chat on my Substack. This is where I'm talking about my specific trades, how I'm actually doing things. A lot of you guys follow me for TLT ETF, my long-term bond position, which I had put out a video maybe about 2 weeks ago regarding that. And I talked about how I went long TBT ETF, which is the inverse to what TLT ETF would be like. TLT ETF, of course, is moving down, which means my TBT ETF trade is working out positively. I'm not getting rid of my TLT. That's a long-term trade. I am looking at SPY ETF as well. Haven't pulled the trigger on that yet, but if you go to the chat section on my Substack, you can find all this information, how I break that down. It's a great way to ask me questions. Moving ahead. Now, this is, since the beginning of the year, I almost got that perfectly on January 1st. This is FEZ ETF versus SPY ETF. These are the two major indexes, the S&P 500, SPY ETF, of course. FEZ ETF is against the European Union version of that. You can see a divergence here. Significant. The S&P 500 since January 1st, now it rallied, then sold off, but since January 1st, S&P 500 is down about 3.25% for year to date. Whereas you can see some, 14.5, almost 15.5, pushing 20% increase for FEZ ETF. Now, one of the things that's going on, of course, is the expansion of the budget in Germany and EU. I mentioned that. I'll break that down systematically, but this is year to date, and you could see that the policies of what Trump's trying to do is detrimental to stock growth, our investments. Fine, but we're looking for growing our investments, so we're going to be looking at growth. One of the things I like is going all the way back to 2020, March 2020, when everything shut down. This is the same ETFs, FEZ ETF versus SPY ETF. I think this is daily chart, but it gives you the time frame from 2020 all the way up to current. Now, since about, I want to say June-ish, they were fairly neck and neck, these two ETFs, the indexes themselves. But we've seen a lot of hyper growth. Some of this is coming from NVIDIA, Tesla, a lot of these stocks that really accelerated toward the over the past year. We're seeing that kind of move in a different direction. We've seen the stock market, again, as I mentioned earlier this morning, was down again because of Trump's tariffs that he's imposing on the United States for automobiles. Now, the United States auto industry is so integrated, it could mean chaos. Who knows? We'll see how it plays out. Again, one of the most important factors in investing is predictability. And we're not getting any kind of predictability other than unpredictability is what you can predict. But I look at this as more, he's trying to remove the United States out of globalization and just basically saying America will make all its products. And if you want to buy American products, that's great. But don't even think about selling products inside the United States. I kind of look at it that way. Maybe it's a good thing. Maybe it's not. It's just a thing. One of his arguments is our manufacturing industry has just been decimated. We have a 4% unemployment rate. No one's really kind of missing out on jobs. That's one of the things. Now, I get the differential in trade. That's a bad thing, of course. But looking at this particular chart, this is the S&P 500, or in this case, SPY index. SPY ETF, one of the things I like to point out is how we got here. Now, this is tremendous growth, but there were a lot of things that happened. First, we had 3 stimulus programs along with quantitative easing. And I think understanding this backdrop really will give you the ability to understand how the SPY ETF got to where it is. It was Biden who was able to push through the $1.9 trillion stimulus package. Now, we have a $35 trillion economy, so 2% is not quite 10% of the total economy. Still, 1.9. Keep that number in mind. That's important. Now, we also had 2 stimulus check programs go through with Trump. That, of course, helped out. But getting manufacturing moving again, we saw a big plummet in manufacturing because of COVID. And then the program, the American Recovery Act, did bring back more manufacturing. We've seen a lot of growth in manufacturing, a lot of growth actually. So this was part of it. Another thing is, and this is such an important factor if you want to understand economies and how things sort of transpire. I just did a video, I think it was last week's video, on the US dollar, the carry trade. You might want to check that out. Understanding this concept is such an important thing. It's just get this quick foundation so you have a better understanding as to why the United States did so well during this period of time on a relative basis, and while they're not going to do so well relatively in the future. Take Japan, and I'll do this real quick because I know a lot of you guys have actually seen this video. Take Japan, all right? You could borrow money in Japan at nearly 0%. You could have deposited that money into the United States at, say, 5% interest once the Federal Reserve started moving interest rates up higher like they did. And they started moving their interest rate in 2022 through 2023. If there are traders who would have actually gone into banks in Japan, borrowed billions upon billions at 0% interest and deposited into the United States of America. The only thing you had to do was sell Japanese yen and buy US dollars. By doing that, this propped up the United States dollar relative to the Japanese yen. I have those charts in just a second. But that money then goes to work here in the United States of America. All right, the money, the growth of the money supply is the fuel or the growth potential of the United States of America. So just kind of keep that concept in mind for a second. The US dollar did appreciate heavily versus Japanese yen. Not the first time it's done this. I'm a former FX trader, so this is something that I continuously am focused on. Where's the dollar? Where's the dollar? I'm shifting over to equities, of course, and have been doing so for a number of years. But I'm still dollar, interest rates, economy. That's where my foundation is. So Japanese yen, of course, did depreciate in value relative to the US dollar. And now we're probably going to see that shifting. Of course, we saw higher debt levels. The United States of America pushed its debt to GDP ratio from about 100% to about 125%, corrected it somewhat. Now we're down to about 105%, but moving back upwards. Or I'm sorry, 120%. I think we're pushing 122, looking like 123 is going to be happening here. We could see 130% debt to GDP ratio because of some of the moves, the policy shifts. Of course, we saw inflation. Now, keep one thing in mind. A lot of this inflation, there was 2 things. Number one, housing. Interest rates for a time there were nearly 0 on the overnight for the Federal Reserve. Mortgage rates were what? 2 3/4, 3 1/4, something like that. The housing industry skyrocketed. That's where a lot of the inflation came from. 70% of the inflation growth that we did see was because of that. And I've said in a million videos, the Federal Reserve is just destroying us with these super ultra low interest rates. They created this. And a lot of people always point the finger at a president saying, well, it's your economy. It's not really the president's economy. The president doesn't have a whole lot that he can do to spur an economy forward without the help of Congress. A president can take steps to restrict economic growth, of course. Usually that doesn't happen. Another thing for inflation, the price of eggs. And I've seen this, I don't know how many times. We're like $6.25. It's more than double current prices where it should be or where it was relative. And I've been reading things that, on a supply demand basis, maybe the price could have gone 20 to 30% higher. We're being gouged. This isn't inflation. This is profits. Take a look at the corporations who are reporting record profits after record profits. They're certainly not reducing their prices in order to help consumers. We're being gouged. We saw housing shooting up. Landlords is like, pay up. And now we're seeing the grocery stores do exactly the same. Okay, so we had some inflation. But moving forward, this is the dollar index. And you can see how when the Federal Reserve increased interest rates, the dollar increased in value. Money moved from Japan into the United States, and then it went to work and our economy expanded. Now the dollar index is versus all currencies. So this would also be versus the EU, Great British Pound, Swissy, Canada, Japan, and New Zealand, and a couple others. This is FXY ETF, aka the Japanese yen. Now, I'm using the ETFs on this because as a currency trader, I would have printed dollar yen, but it's inverted. So this is the US dollar, or the dollar versus Japanese yen would be inverted to this, and it would be much higher. But what I wanted to show in this chart, and why I'm using FXY ETF, the Japanese yen ETF, is simply because I wanted you to see what the Japanese yen looks like relative to the US dollar. So I inverted it, and I'm using this ETF. And as you can see, it's on the downside. I'm looking to get into selling dollar yen because I believe that the Japanese yen is going to rally somewhat, not a huge amount. Japan is raising interest rates, so that differential between the United States and Japan is narrowing, which means money would move out of there. At the same time, we're probably going to see the U.S. economy, the Federal Reserve lowering interest rates, and that again would push dollar yen downward or FXY ETF upward. All right, what is the United States going to look like, the economy, if it was fully removed from the globalization era that we're in? And this is kind of what we're seeing. Bottom line, we look at Brexit for the sort of formula as to what the economy in the United States will look like. There will still be growth. There will still be employment, but it's just going to be a little bit less. Now, that's if you look at how Brexit, of course, the United Kingdom leaving the EU, if you looked from that perspective, what we're going to be imposed upon us is far more punitive. England voted to just leave, and so they did. It took them a few years. It took them like 5-6 years till they finally left. But it wasn't done so in a punitive manner relative to purchasing with 25% tariffs. So Brexit gives us an idea, but then you have to push it a little further. One of the things, and I've read a ton of articles on this because I'm kind of saying, wow, this is what's happening to the U.S. economy. What happened with Brexit? One of the things is the United Kingdom has lower exports to the EU. Simply put, there's barriers there. It's no longer free trade. So companies in the United Kingdom are not experiencing the high levels of export that they could have. They're still exporting, just not nearly as much. Is that a good thing? A bad thing? It's just a thing. It's just slower. They have higher debt levels. The debt and this is cumulative. One of the things is they have a slower GDP growth rate relatively to what they could, and because of that, They have higher debts because they're not bringing in as much taxes, and that prompts their yield curve on the longer end to be higher interest rates, which means higher overall costs for consumers in the United Kingdom, which ultimately deteriorates and wears down economic growth inside the United Kingdom. We will see that. We will see that probably more so than what the United Kingdom saw relative to leaving the EU. Interest rates, as I mentioned. So the long end of the yield curve is higher. So we can expect higher debt levels here in the United States amidst slower GDP growth. The United States federal government isn't going to take in as much debt, but their debt to GDP ratio is likely, or deficit to GDP ratio is likely to increase rapidly and more so. And because of that, the United States of America is going to have to raise more money, and that's going to mean higher interest rates. That translates into a higher mortgage rate. That translates into a lot of things that negatively deteriorate growth rates. We might still see positive growth rates, just not nearly as high as we could. We won't be as competitive in the international markets. But in this case, because of the tariffs, a lot of countries are basically saying, I'm not buying anything American. So from an international basis, we might see a lot of international companies seeing their revenue growth deteriorate overseas. There's some backlash that's coming. Reduced GDP growth, of course, it's all encompassing, and I've mentioned this, but these are the things that we can probably expect here in the United States on a relative basis. We could have seen higher growth with a pro-growth economic policy coming from Washington. We are definitely not seeing that. Relatively, the EU is far more advanced. Germany, they just passed a $1 trillion infrastructure and defense expenditure bill. Now, here's the thing. In order for them to do that, they also simultaneously had to amend the Constitution. I think it was in 2008 they put together a constitutional amendment that basically said debt to GDP ratio will be maintained, the deficit will be maintained at a certain percentage, and the people of Germany are going to insist that Germany, the leadership in Germany, is frugal, plain and simple. So in order for Germany to have passed a $1 trillion infrastructure and defense budget, which would have pushed those numbers, they had to add an amendment to their constitution, which takes a supermajority. Now, what is the driving force of this? Europe believes that Europe is dead set that America is no longer trustworthy. We're no longer a reliable partner to Europe. Good thing, bad thing? Well, on the one hand, take a look at Russia. I mean, Lithuania could march on Moscow right now if they wanted to. There's 450 million individuals in Europe. There's 135, 140 million. The numbers are changing because everybody's leaving Russia. They simply don't have a competitive advantage. Their military structure is just obviously not top notch. But this gives you an idea that should the United States of America leave, you know what? Europe will be just fine. Will it happen? I would not be shocked if the next things coming out of Trump's mouth are, I'm tired of NATO. They don't pay their bills. Okay. Germany is going to step up and say, fine, we'll take care of ourselves. That relic of 1950 is done. Therefore, we're going to take care of things ourselves. At the same time, the EU pushed through an $800 billion rearmament package. So effectively, the United States doesn't need to be there anymore, which means the United States theoretically could slash its defense budget. I don't know that they will, but regardless, this is not a pro-growth scenario for the United States, but it certainly is in Germany. Keep in mind. Now, part of that 800 billion rearmament is what Germany is pushing through. But this is $1.8 billion being spent inside Europe. The United States of America spent $1.9 trillion in the third stimulus. A lot of similarities. Big difference. Germany has about a $5 trillion, not even $5 trillion. The $1 trillion in expenditures is 22.9% of their total GDP for 1 year. This isn't all going to be spent in 1 year. It's going to be spent over several years, but this is ginormous on a relative basis. Germany and the EU are going to see a lot of growth relative to, say, what the United States is doing. They may chop the defense budget significantly and say, we're tired of taking care of Europe. That's not an improbability. But you can see how these numbers are definitely growth oriented. And that's something that I'm really kind of keying up on. This is the German 10-year bond yield. Now, similar to the United States of America, it has been moving higher, but this is the same German 10-year bond yield versus the U.S. 10-year Treasury. Same period of time, the United States had higher interest rates across the board. I expect that a lot of money is going to start flowing into Germany, the EU broadly speaking, which means the euro currency will see appreciation. Japan, investors in Japan are probably going to start investing in Europe more so than the United States. We'll probably see money moving out of the United States. German investment banks, Deutsche Bank, all those banks, are going to be actively picking up the phones and bringing money in to pay for all that debt. Okay, that is going to increase their debt levels, which means interest rates will continually move higher to attract more investors. So I expect the German 10-year bond to move higher on a relative basis versus the U.S. 10-year Treasury. And that's something that's such a key aspect of what's going on in the economies and how the EU will outperform the United States. All that money leaving the United States is our future growth opportunities. Whereas all that money going into Germany and the EU is their growth opportunities. Plain and simple. Go back to what I showed you in the beginning where COVID, all that money flowed into the United States and the U.S. economy expanded nicely, given the fact that we basically were in a shutdown scenario. This really was also a big portion of the engine of growth for the world. As long as the U.S. economy kept moving, expanding more and more, the rest of the world followed suit, and we recovered from COVID. Now, this is FXE ETF, the euro versus U.S. dollar. And you'll recall that Japan, of course, saw a deteriorating number, but the euro currency itself bounced more so than what happened with the Japanese yen. I expect money from Japan to be flowing into Europe. I expect money from the United States to be flowing into Europe as savvy investors chase higher growth differentials. So you start putting all these pieces together. The United States economy will not expand as rapidly, if not go negative, relative to what's going to happen in Europe. And that's such a key factor. It will affect interest rates over there. It will affect the currencies. And it will affect defense expenditures and things like this. This is what I've been breaking down in my newsletter. So we go back to FEZ ETF versus SPY ETF. I see these two differentials narrowing. And it may be that the SPY ETF sputters out a little bit. It may be that SPY ETF goes higher. Regardless, I see FEZ ETF outpacing the growth rate of SPY ETF. Now, if you're a super savvy investor, and I keep sitting here trying to put together this trade myself, figuring out, I know SPY is going to underperform FEZ. I just know that one. So how do I make money on this? Simple. You buy FEZ, you sell SPY. That's a fairly sophisticated trading mechanism. You're going long one, going short another. And that would entail, and I'll probably figure out some ways on how to do this using options trading. I still haven't pulled the trigger on this, but the idea is simply this. What if you have three scenarios? Both of these equity indexes move higher, equity indexes move lower, or they move sideways. One of those three things is going to happen. Now, and it's all relative. Could it be possible that they move in different directions? Yes, that's probable. But I don't see FEZ ETF going down where SPY ETF goes up. That's the one scenario that I just don't see happening. If SPY ETF does move higher, FEZ ETF is going to also simultaneously move higher and do so at a pace that is far higher than SPY. So if you did buy FEZ, sell SPY, that narrowing, you'd be profitable. Again, that's a fairly sophisticated trade. I don't necessarily try to promote those kinds of things. It is something that I'm doing, and my content is basically, this is what I'm doing, and these are the reasons why. And I know a lot of you guys follow this kind of content so you can put the pieces together and learn how to invest your money. So that's how I kind of break things down looking at this. Now, FEZ ETF itself, great little ETF. I wanted to lay down the framework of this particular ETF and why I believe these things are going to happen moving forward over the course of 2025 and 2026. I will individually break down FEZ ETF on a regular basis. I'm going to continue to push that kind of content out there. I believe that Europe is going to be the area of growth relatively to what's happening here in the United States. Sure, U.S. stock markets might go higher, but FEZ ETF will go higher at a faster pace. And that's one of the thesis takeaways for all of this. This is understanding the economics and how money starts moving and how that invigorates an economy is such a key factor in understanding how to invest your money. If you're looking for growth, maybe you ought to start thinking about diversification. In the meantime, make sure to hit the like and follow buttons. I repurpose my videos now. I am pushing everything to Substack. This video you'll probably find on YouTube, LinkedIn, Facebook, and Substack. But all roads lead to Substack. So if you've made it this far in the video, thanks so much for following along. My numbers are jumping big in Substack, so thanks so much. You can get the free video delivered to you versus finding it, stumbling on it via YouTube or Facebook or wherever it might be. Make sure to hit the like and follow buttons. We'll see you in the next video.